Hi, good morning everyone once again. So the paper that I'll be presenting examines how regulatory interventions affect the behavior of market participants. This we are examining particularly in the context of algorithmic trading in India. And in particular, we examine whether these regulatory interventions achieve their intended objectives and do they also have some unintended objectives in the process, unintended consequences in the process. The paper is co-authored with Saugata Chakravarti, Venki Panchpagasan, and Susan Thomas. And before I proceed, a remark, this is work in progress. And as I'll go with my presentation, I'll also elaborate on what we plan to do next. Okay, so before I get to the specifics of the problem, a brief background into it. So advances in technology over the last few years have really altered the market microstructure, have changed the way markets worked. And one outcome of this has been an increase in algorithmic trading. And I think by now everybody knows, but just a recap, what is algorithmic trading? It is primarily punching orders by an algorithm instead of a manual trader doing that. Now, in theory, it sounds very good because primarily you're using machines, which eliminates the error, human error that would be possible, the possibility of a human error. And also, because the reaction times will be smaller, you also expect that the information will be incorporated into the prices more easily. So you would expect that, yeah, once algorithmic trading comes into the market, the world will be all good, and maybe we are in a better world. But in terms of, there's so many studies that have examined how this has impacted the markets. Has it helped the markets or not? So benefits, yeah, there has been increase in the liquidity, but there are a lot of concerns regarding the negative externalities that these algorithmic traders pose. And these, to mention a few of them, they include one, that these guys benefit at the cost of slow traders because algorithmic traders have access to speed while others do not have. The fear is that those slow traders who actually should sustain in the market, they are getting crowded out. That is a fear which has not really been tested so much. The second fear is that this trading activity is resulting in a lot of investment into the technological infrastructure. And the question really is that, is it socially optimal to invest so much? Is the society benefiting at the end or not? So there are these concerns, and while nothing has been so far established so well, but there has been an immense pressure on the regulators as a result to do something about it, to do something so that this algorithmic trading activity gets contained to a certain extent. And as a result, various policy proposals are being contemplated around the world. And to mention a few, there are MiFID II regulations, HFT Act in Germany, etc. Now, coming to the regulatory intervention, going to the basic economic theory, when is a regulatory intervention justified? Any regulatory intervention is justified when there is an identified problem, and then it is known that the markets cannot correct that problem by themselves, and therefore you need to intervene. So you expect that this proposed intervention would address the market failure appropriately, that too in such a way that the costs are outweighed by the gains that it brings to the society. The question really is, when these considerations are ignored, the intervention can result in unintended consequences. So this paper examines the effect of one such intervention in the context of the Indian equity markets. And the intervention was to charge a fee or penalize traders who have got high orders to trades ratio. The question that we are examining is did the intervention address the market failure? And two, were there some unintended consequences of the intervention? Now, what is the OTR fee? So the rationale, what is the target here? The target is to reduce high levels of OTR. And why high levels of OTR is a problem? What's the market failure, expected market failure there? It is that it causes negative externality by way of, one, increasing load on exchanges infrastructure. That is, that when any trader is punching in a lot of orders, then it clogs the exchange's order flow pipe, as a result of which the exchange has to invest further in order to upgrade its system so that it can allow for a large number of orders at its facility. The second problem is that the second fear rather is that orders that rarely result in a trade could be unproductive for the system because one, they can increase latency in order placement and execution for other traders. So because of this fast trader punching in so many orders, I'm not able to send in my orders because I'm a slow trader. And the second thing is that there is also risk of market manipulation, that maybe there is something untoward that these guys are doing which is not beneficial for the markets as a whole. So what is the solution prescribed? The solution is that you impose a fee if the OTR for any trader crosses a certain threshold. The expected outcome is that the cost of high OTR will be internalized by the trader, and therefore he will either adjust his behavior in terms of now sending lesser number of orders, or make sure that the orders that he sends get executed. So the probability of execution should increase. That's the expected outcome. However, it has also got an unexpected outcome. That is, if the fee is not designed appropriately, it has potential to affect market quality, specifically in terms of market liquidity and liquidity provisioning primarily. So our focus is to analyze this intervention in terms of these two outcomes. Now, what are the advantages of this paper? What sets this paper apart? So there have been a few exchanges that have implemented this fee worldwide. These include the NASDAQ, NYSE Euronext, OSC, which is Oslo Stock Exchange, Italian Stock Exchange, and Toronto Stock Exchange. But the key part of this fee is that it was implemented due to regulatory pressure, which was after the flash crash of 2010, regulators were like constantly pressurized to do something, and as an ad hoc measure, they had imposed this OTR fee. There are a few studies which have examined the impact of this fee. These include Jorgensen et al. Paper, which is 2014, and they examined the impact of the fee on the Oslo Stock Exchange. What they find is that after the fee implementation, the OTR came down, but it did not have any adverse impact on market quality. Friedrich and Pan is another 2013 paper, and they analyzed the Italian Stock Exchange, and they find that there was a decline in OTR, but there was also a decline in market quality. So there was an unintended consequence of this fee as well. And there's this third paper by Marinova et al. They examined Toronto Stock Exchange, and they find that the similar results as Friedrich and Pan, and they also find that market quality worsened after the implementation of the fee. So what is so unique about the OTR fee at NSE? The point is that there were two implementations of this fee. There was one implementation in 2009, which was an exchange initiative. So in 2009, remember, there was no fear of algorithmic trading as much as it is today. And the exchange implemented this fee on its own because they realized that there were a lot of orders that were coming into the markets without any execution, and it was putting a lot of pressure on their bandwidth. Hence, they had implemented this fee on all the orders that came to the market. In 2010, they reduced the fee because they had upgraded their systems. Now, in 2012, the fee was reintroduced into the markets because of the regulators' pressure on the exchanges. So the regulator came in and said that worldwide there is so much fear about the algorithmic trading, and I want to do something, and therefore they imposed this fee on only algorithmic traders. I'll come to the details of the fee. So this is a graph which shows the evolution of algorithmic trading on the NSE single stock futures market. This is for the overall, all the stocks taken together, aggregated level. So this graph spans from 2008 to August 2013. And you see that it rose from approximately 20% in somewhere around 2010 to now in 2013, around 70% it is. The dotted lines are the ones that are the lines of interest. The first line that you see here, this is the time when NSE first levied the fee because there were a lot of traders who were sending a lot of orders that went unexecuted. The second line is the line when NSE reduced the fee. The third line is when SEBI came in and said that we want to levy this fee only on algorithmic orders. And the fourth is the time when SEBI doubled this fee in 2013, May 2013. So these are the specific details of the fee. 2009, it was uniformly levied across all market participants and all order types. 2012-13, it was only implemented on algorithmic orders with certain exemptions. One, orders which were outside the limits of plus minus 1% of the LTP were to be counted into this fee. So basically, if you're a trader and you are sending an order at rupees 100, so suppose the trading price is 100, and you are sending an order at 102, then you are breaching the plus minus 1% LTP limit, and therefore your order will be charged or will be charged in this fee. And if you're a trader who is posting an order at 100.5, then you are within these limits, and therefore your order will not be counted in the computation of this fee. So that's the first exemption. Second is members who are covered under the liquidity enhancement scheme. They are also excluded, but the point to note here is that this liquidity enhancement scheme is only for illiquid securities, illiquid derivatives, which are indices that are traded at NSE. So none of the single stock futures have got this scheme. Third is, which is an additional penalty, and this is actually unique to India. There is no such additional penalty around the world, which is that if your OTR for the day crosses 500, then you will not be allowed to trade next day for the first 15 minutes. So we're not sure about how effective is the monetary penalty, but perhaps if this might be a bigger penalty for any trader. So, and further, the fee is computed at a level at a member level on a daily basis. And fee is implemented only on the derivative segment. There is no such fee on the cash, and which initially we thought will work well with our experiment, and we'll take cash as a control, and we'll be able to analyze the impact of the fee on cash by using cash as a control and futures as a treatment. But then because cash and futures are so tied so closely with the arbitrage, we realized that we can't use cash as a control, because cash is also indirectly affected even if there is no fee. You will change your behavior on cash as well. So therefore, I will not be discussing those results in my presentation. Okay, so what we find primarily is, first of all, when NSE imposed the fee in 2009 and reduced it in 2010, we saw that there was a significant impact on OTR. OTR came down, and there was no corresponding impact on market quality. If at all there was any impact, it was in terms of some improvement in terms of market quality. We are still working as to how, what will be the channel around that. For SEBI imposition, we do not see any impact of the OTR fee in terms of bringing down the OTR. And for market quality measures, we find mixed effects. Now I'll come to further details of this. So the data that we are using, we use all the stocks that are traded on the NSE derivative segment. And the period we analyze for all the 4 events. Event 1 is for 2009, when the fee was implemented. Event 2 is 2010. Event 3 is 2012, when SEBI came in and introduced the fee. And event 4 is 2013, when SEBI doubled the fee. And okay, and we examined 3 months pre and 3 months post the event. The segment that we are analyzing right now is only near-month single stock futures. The data we are using is tick level data, orders and trades data, and the trade data has got flags which identifies whether an order is coming from an AT trader or a non-AT trader. Also, there is a flag on the type of order event. So whether so we have got order IDs, and we get to know whether the order was modified, cancelled. We can track the life cycle of the order from this data. Okay, some facts. Actually, I think Professor Yadav mentioned this in his slide, but that was for 2006. And I'm showing this to you for 2009 and 10. So the first row in this, in this table, it captures the percentage of trading activity by algorithmic traders in 2009 as event 1. And you see that it was 18.36 and rose marginally after the imposition of the fee to 19.33. Even in 2010, which is the second column separated by the line, this rose to, this was somewhere around 20% only. But what is there to be noticed is the number of orders that are entered and number of order events. So if you look at it, the number of order events are actually 5 times the number of orders entered. Why? How do I define order events? Order event is any order that gets entered, modified, cancelled. Any activity on the order is counted as an order event. And so for a stock on an average that gets traded on the single stock futures market, the order events are 5 times the orders that are entered. Maybe that's a peculiar feature of the markets. I'm not saying that is good or bad. What are the sources of order events? If you look at 2009, algorithmic traders sent majority of the orders, and they were the people who dominated or who made a lot of changes to their orders, about 55% of the order events by algorithmic traders. Same for 2010. If you look at the percentage of orders that actually got traded, that's very small, both from algorithmic as well as non-algorithmic traders. Of course, the percentage is a little higher for non-algorithmic traders, but that could also be attributed to the lower share of algorithmic traders in the market. These are similar figures for event 3 and 4, that is period of 2012 and 13. And you see now number of orders, first of all, AT intensity, the percentage share of algorithmic traders in the total trading activity has increased to 60% in 2012 and 65% in 2014. And if you look at the number of orders events, or number of order events as a proportion of orders entered, it is now 10 times. So earlier it was 5 times, and now it is more than 10 times. And again, the source is now primarily algorithmic traders, and the orders that get executed is even smaller, less than 1%. Okay. So now I'll come to the measurement details, how we are capturing OTR. I would like to tell you, so we do not have data which identifies the trader category. So we cannot compute OTR at a trader level the way it is actually done by the exchange or from the regulators. So how we do it is, for every order, we compute the orders to trades ratio as the ratio of number of order events divided by 1 plus number of trades. Why we have added 1 is because most of the orders do not get traded, and in which case, if we do not include 1, then the number will become infinite, not sensible. Therefore, we just added 1 for this sake. And OTR intensity is something to just capture the how much load how much load it puts on the exchanges system. So it is computed as OTR to the ratio of OTR to average time between modifications. Higher is this number, it would indicate that higher is the pressure that you're putting on the exchanges infrastructure. So for each, first we compute this at an order level. Then for each stock, we compute the value weighted average OTR for the day. And to get average for the day, we compute the market cap weighted OTR across all the stocks. Now, this is the OTR graph pre and post the event for stock futures. So the first graph that you see here is the time when NSE implemented this fee. So you see that there was a significant decline in OTR. The average value reduced from 5.31 to 4.17, clearly indicating that what the exchange was trying to do was very much achieved after this implementation. Event 2 was the time when NSE reduced this fee, and you see a marginal increase in the average OTR, but we checked the statistical significance, and it is insignificant. So this marginal change is not so significant. Event 3 is when SEBI came in and implemented this fee again. We do not see any impact on OTR, and all that we see is actually some rise in the orders to trade ratio after the implementation of the fee. The fourth is when SEBI doubled the fee, and there is absolutely no impact of the fee here. So there are a lot of questions that these graphs are now throwing at us, which include that, first of all, when the first event happened, was it a shocker for the traders, because of which at that time they could not do anything but change their trading strategies, and therefore the OTR actually came down. And by the second, third, and fourth event, they had very much adapted to this new system, and OTR fee does not matter any longer. Yeah. So that could be one. Second thing is that maybe when SEBI imposed this fee in 2012 and 13, 2012 and 13, there were a lot of exemptions, and it could be the case that most of the orders that are placed are do not fall into the OTR category, OTR levy category. That could be another. So these are things that we intend to explore further. Or maybe it could be that people change their trading behavior, the volumes, the activity moved from futures to cash. And therefore, I'll show you another graph which shows the OTR graph on the cash market for the same set of stocks. And what you see is that after the first event, cash, there was no fee, but on the cash market, OTR stabilized a bit. In event 2, it increased. Event 3, there was somewhat decline. We do not have any explanation to that. But event 4, it increased further. What is to be noticed here is that as against the futures, the OTR values have increased steadily on the cash. It was somewhere around 5 in 2009. It increased to 10 in 2010. It increased to 20 in 2012. And it increased to 25 and somewhere around 25 to 30 in 2013. And the real question is, why is this happening? Is it the case that now people are trying cash more than the futures? These are things that we plan to explore going forward. Okay, now I'll come to the market quality measures that we have analyzed. In terms of transactions cost, we analyzed the quoted spread, impact cost. Depth, we analyze, so impact cost is like cost of immediacy that Pawan discussed in the previous presentation. Depth is top rupee depth available at the best bid and ask. Top 5 depth is the cumulated rupee depth available at the top 5 best bid ask prices. Then we also capture Amihut's liquidity measure, which is the ratio of daily absolute stock returns to traded value. For efficiency, we use variance ratio of 10 minutes variance of returns to 2 times the variance of 5 minutes, and the optimal value is 1. Basis we capture as difference in the actual and implied futures price relative to the spot price. Volatility we capture as the variance in returns. We also look at liquidity risk, that is, has there been an increased liquidity stress in the markets or not, which we capture as the standard deviation of impact cost. Basis risk is the standard deviation of basis. And these are the descriptive statistics around market quality. So on the whole, for event 1, what you will see is actually market quality improved. So the first column, these 3 columns are showing that, okay, these look to be similar, but it is somewhere around 5, 6, and this were around 6, 2. Basically implying that market quality improved in terms of reduction in transactions cost. Top rupee depth, it seems that it improved. Top 5 depth also improved. The only negative impact that we saw was in terms of a reduction in an increase in basis, which is perhaps because cash and futures are so tied so perfectly, and if there is fee for one, then it becomes costly to execute a strategy on the other. That could be one reason. Event 2, similar things, not much impact we see on market quality variables. This is for event 3 and 4. Again, we see somewhat decline in the transactions cost, but I'll also point out to this value, which indicates that top 5 depth, that is the depth at top 5 prices, declined after SEBI doubled the fee. And rest, it is similar. It improved market quality. At least the descriptive stats show that. We evaluate the impact of informational efficiency in terms of basis and basis risk by using a regression approach. And the regression that we use is specified here. We use value-weighted OTR, that is the value computed out of the stock's average OTR, that is fee dummy, which captures whether if the period was after the implementation of fee, it will take value 1, 0 otherwise. Then an interaction term between the two, value-weighted OTR and fee dummy, and the coefficient of interest is actually beta 3. So if the event did not have any impact on basis and basis risk, it would imply that beta 3 should be 0. These are the results. And for all the 4 events, except for event 2, we see that the value is actually 0, which implies that there was no significant impact on basis as well after the implementation of the fee in terms of a regression approach. So I'll quickly come to the conclusion. So worldwide, there are a lot of concerns regarding HFT penetration, and perhaps the need for corrective action is justified. But before you take any corrective action, the point is you need to know where the problem lies. In this case, it seems from the analysis of event 1 and 2 that the exchange knew where the problem was, and they knew what was to be achieved, and therefore they designed the fee in such a manner that it could bring down the OTR. It achieved its goal in terms of reduction of OTR without any deterioration in market quality. The analysis for event 3 and 4 suggests that the regulator issued the guidelines, but it is not clear as to what were they targeting. Were they just implemented this because they had to do something, or they were targeting something that perhaps this data is not pointing out as to, or maybe we have not captured it that well. So the objectives does not seem to be well defined in this particular exercise. Now I'll go on to the extensions that we have got for this paper. We plan to do some formal analysis of how the fee has impacted the stocks after the fee implementation. We'll also separately examine the impact of the regulation on big and small stocks based on market cap. It could be that the small cap stocks were impacted adversely than the big cap. Then we plan to examine the impact on liquidity provision post the event. And lastly, we also want to see what percentage of orders fall outside the 1% LTP limit, which was the case when SEBI had implemented it in 2012 and 13. But just to give you an idea, we had done this for the top 50 stocks, and less than 1% of the orders were such which fell outside the 1% price limit. So our real question was really what was SEBI targeting when they implemented this fee? Thank you.
So it's a great pleasure to be able to discuss this paper. I have seen it before 3 months ago, and I enjoyed it then. I enjoyed it even more when I had the responsibility of making a discussion. So what did the authors investigate? The authors, the NSE imposed an orders to trade ratio based fee on all traders in 2009 and made changes to it in 2010. SEBI imposed an OTR based fee on algo traders only in 2012, changes in 2013. And the paper examines the impact of these fees on liquidity measured in a variety of ways: quoted spreads, impact cost, rupee depth, and Army Hood liquidity measure, on pricing efficiency, measured again through the variance ratio and the basis, and volatility, as measured in terms of volatility of prices, volatility of liquidity measures, and volatility of the basis. So very comprehensive examination of the impact of these changes. And what the authors find is that the fee imposition successfully reduced OTR in 2009 and 10 when the NSE had done it, and did not impact market quality adversely on that occasion. On the other hand, in the case of the SEBI fees only on algo traders, the fee imposition was not successful in reducing OTR, and its market quality effects were mixed. So once again, I thoroughly enjoyed the paper and would strongly recommend you reading it. My criticism or my suggestions are really based from the perspective of the authors, assuming that they want to place the paper in an academic journal. So the paper addresses an extremely important question. The study of the impact of OTR fees is very relevant, both from an academic and a policy perspective. It's important for academics, regulators, and market participants alike, and important globally. So the head of the US Securities Exchange Commission at that time had indicated that the SEC was considering implementation of an OTR penalty scheme in the same form. And of course, the Markets and Financial Instruments Directive in EU has it mandated from 2016 and across the board implementation of OTR fees. So clearly, this is a very important measure. And as I said, overall, the authors have done a thorough job in the empirical examination they've undertaken. The empirical research design and analysis is competent, inspires credibility, and the empirical results are very interesting. Now, my comments relate to what is the purpose from the author's perspective of writing the paper. One, policy and relevance to India. It's an absolutely fantastic contribution from that perspective. Number two, all the author academics, they want to publish the paper in a top journal. And from that perspective, I think the paper needs more work to provide a contribution that can be sold effectively as being significantly incremental to already published research and competing effectively with existing unpublished research on the same topic. So in that context, there are several papers which are examining virtually the same question. We have Frederick and Payne, which is, I suppose, unfortunately, from the perspective of the authors, already forthcoming in Journal of Banking and Finance, and which is based on the Italian exchange. And they find that the market quality significantly worsens with an OTR fee. Then there is the Norwegian paper based on the nuanced targeted rule changes at the Oslo Exchange, which finds that OTR increases, find that OTR decreases and market quality is unaffected. So we find that the impact is, the results are very similar to the current paper on the Indian exchange. And then there is Malinova 2013 based on the Canadian exchange, who find that the market quality significantly worsens with the fee. So the question is, what is the bottom line? You have these 4 investigations in 4 different contexts, and our paper here on India corresponds to the results of the Oslo paper, does not correspond to the results of the Italian and the Canadian exchange. And the question is, where do we go from here? So what is different about this paper from an academic perspective? For the authors argue that they examine a change which was initiated by the exchange in contradistinction to that by the regulator. Now, it is true that in 2009, when NSE introduced the exchange, the fees, change fees, algorithmic trading was not that big a deal. And they introduced it primarily to not to impact their systems. However, the Oslo study was also a regulator-induced change and still achieved its objective without affecting market quality, like the India case. The Italian case was also exchange-initiated, though it was targeted, both of these were targeted at HFTs. It is true, and the authors argue that they control perfectly because the change affects only the derivatives and not the spot. Of course, Nidhi withdrew that comment at the time, and I wanted to essentially say that the other studies have reasonable research designs as well. So we have to do something in order to be able to sell the paper to an academic audience. It is very tremendously relevant for policy perspective in India, but what do we do in order to sell the paper to an academic audience? So, and in that context, I don't have any ready-made answers, but I think we need to think about what are the conditions. We need to examine more carefully the conditions under which the impact of an OTR fee change can produce different results, and formulate hypotheses and test them. And here we have a cross-section of stocks which can be utilized, which has not been utilized at all so far. There's an entire cross-section where if you have OTR rules, the OTR fee would affect different stocks differently if that fee is not calibrated properly. So how does the calibration of that fee impact on that result? Here we also have a situation where in the first case, we have the National Stock Exchange of India introducing the fee because of its own reasons. I presume the BSE did not impose a fee at the same time. So we have we have another exchange which did not impose a fee at the same time, which has commonly traded stocks, whose stocks are very closely linked to each other, and where traders who were potentially adversely affected can go. So that is one area of comparison. The other area of comparison is the fact that this fee is only in derivatives, not in the spot. Now, The paper uses that as a control and looks at the basis. I feel that basis is not the right thing to look for. Essentially, what the fee would do would be to make, if there is a fee only on the NSE, not on the BSE, orders should migrate to the BSE if they can subvert the action of the fee by going to the BSE. If there is a fee in the derivatives market but not in the spot, then to the extent that the two markets are very heavily closely integrated, there is no reason why a lot of movement can take place in the spot. So what is there to examine is the relative roles of price discovery between those two markets. How has that changed? Rather than looking at how has the basis changed, or how is the basis risk less or more. So the Indian market has extremely well integrated single stock futures versus the spot. And what you'd expect from such a change would be that where you don't have the fee, that is where relevant traders would tend to exploit, and therefore the relative price discovery roles of, say, BSE versus NSE or the spot versus derivatives would change. So what are the various considerations which would be applicable when we think of, this is just an example of what we can think of doing, because we need to sell the paper to an academic audience in a way which competes with other unpublished research which exists here. So, and in that context, I don't know whether the fee is like a sort of catch-all fee across all stocks, or it is calibrated differently across different stocks and so on. That is something which I think, once again, stock-wise can be analyzed. But other considerations include, for example, if HFTs are better informed than others, then OTR fees will discourage them from participating in markets. Adverse selection risk would drop and liquidity increase. But OTR fees also damage liquidity because HFTs act as de facto market makers since OTR constrains them. So that's an aspect. Can we utilize it in some way? OTR fees may cause order submitters to curtail liquidity supply with low execution probabilities because they don't get benefit from it. They get taxed. So this could reduce order book depth away from the inside spread. I don't know whether you have looked at that. That's just something which you should be able to find. Then you should be able to see a decrease in resiliency because it hampers the ability of fast liquidity suppliers to refresh the codes. On the other hand, price impacts might fall because HFT traders tend to front run. But I think most important from the perspective of the study is the issue of competition between different order books, whether it is BSE or NSE, or it is derivatives versus spot. Because those venues are substitutable in their ability to contribute to price discovery, then the result of an OTR fee on one venue should be migration of high-frequency coding to an alternative market and little effect on consolidated market-level liquidity. And of course, if both the liquidity suppliers and markets are common, then both venues may be affected. And there could also be a tendency for, particularly in the context of India, to remain on the NSE, now to go to the BSE, tend to be on a particular exchange, so alternative migration may be somewhat limited. So I think for the first two events, the authors should consider looking at the BSE in much more detail in relation to price discovery and order flow migration. Consider examining the relative impact of cash futures market order books based on relative price discovery rather than the impact on the derivatives book after controlling for the cash market. Or they should also look at implied arbitrage daily transaction costs, because that would change. That can be inferred from the basis. And I think, I'm not sure about the omnipresence of the impact, but they should consider examining whether different calibrations of the constraint on order submission can have different effects. And also exploiting the cross-section. So I don't have any comments on the econometrics. It's all great. Thanks.
Thanks, Pradeep. Before I ask Nidhi to respond, we'll take a few questions and then, yeah, Paul.
One question, like just to follow up on what Professor Yadav was mentioning about the migration, I think it will depend if the fee was effective. Like, because the band was so wide, maybe 1%, that's wide enough for people like traders not to be concerned about. And maybe then they are not moving across exchange. So exactly what one suggestion was to look at the different constraint. Like, when would the fee be effective? Because, I mean, you already did that. I mean, you found like only 1% of the order was actually affected by the fee. So that 1% can migrate, but everything else is going to stay the same because that order is not even affected by the fee. So the migration may not be a big of an issue because the band is too wide. Maybe policy suggestion could be to reduce the band and maybe charge a fee if the order is placed within half a sort of percent difference from the mid-quote or the prevailing
So that's
price.
assuming they want to do something.
Sorry?
No,
That's assuming the regulator really wants to have an effect.
Well, that's the conclusion of the paper. I mean, obviously you can.
No, I think your point is absolutely well taken. You can recommend at least.
In some sense, auto migration can be seen selective. Only low orders will migrate.
Right, only that's exactly, I agree with.
Yes, Movis.
just a comment on Mr. Yadav's comments, which is, I think 2009 BSE derivatives was not active at all. So I don't know if the migration thing would be possible. I mean, could be considered by traders at all. The other thing is, like, what is the levels they determined for the penalty, NSE and SEBI? Like, if you go 10:1, or like, was there a big difference, or the ratios were similar? And vis-a-vis, Oslo and so on. Because if they say you'll be penalized if you do 100:1 or 500:1, then it's meaningless compared to someone else saying 10:1. So I think that would be a big.
So how much money did the exchange collect? Do we know that on OTR fees?
It's very small. Actually, Nidhi, do you have numbers on the
Yeah, I have
magnitude?
the number on the levels that there were. So basically, sorry, yeah. When NSE implemented this fee, there were levels of 100:1. I mean, OTR of greater than 100 to 250 had some 1 paisa, then 250 to 500 another, and incremental fee. So NSE reduced it further, and SEBI introduced it. The thresholds they brought down. So it was not starting at 100, but at 50 it starts. So if your OTR is greater than 50, then you'll be penalized some 1 paisa and so on. So broadly they are the same, and I think they're comparable with the international standards as well. I
But
would
50
think.
with the exemption of plus and minus.
Yes,
Yes,
that is valid
that is a
everywhere.
I would be just curious what the get-goes of the world, what their OTRs would be like. Does it go into hundreds, or how? I mean, not that you want to disclose your number.
He hasn't heard about the fee.
Like, what would be a ballpark? Anyone? Like, I mean.
Sorry, could you sort of tell me what it is exactly that you're asking?
Like for the HFT market makers, what would be the typical OTRs you all?
Typical OTRs, I mean, it depends on the market, depends on the sort of participant, but generally speaking, it is somewhere in the double digits, and it's not really much higher than that for most people. And actually, might come to you as a surprise that we're actually proponents of OTR limits.
Right.
But the fee is a different story.
But
The enforcement mechanism and how you actually do it and where it should come from. I think that's kind of something that is worthy of debate. I certainly don't think it should be driven by regulation or by regulators. It should come from the exchange. And if you look, there's some very successful examples of that. I think CME does an exceptionally fine job of doing that. And they make sure that depending on the product, depending on what's going on, they actually adjust that. Having that kind of flexibility and leaving it at the discretion of the exchange is a very, very useful thing. Because the fees, and I throw in sort of a counterexample. For instance, Korea, KRX, imposed an absolute fee on the absolute number of messages, not even ratio. And then very easily, the players kind of separated into two pools. Those who figured out how to pay the fee and stay, and they willingly just would write the checks because they would routinely exceed all those limits and figure out how to recover those costs, and the players that didn't, and that had some very, very bad impact. The counterexample of that, I'll just take 30 more seconds, I think it's interesting for them to know. The counterexample to that is, for instance, in the early 2000s, 2002, 2003, on the delivery of the Treasury futures, people would fail. And because the cost of fail was fully justified by what you would actually pocket by not delivering. This is back on the Board of Trade. The solution to that became very interesting. The exchange says we will impose a fee, and we don't tell you what the fee is. We will set it after the fact, but we will make sure it will hurt you. And then that process stopped. After 2 years of permanent failures of those deliveries, completely stopped. And I think that was one of the most ingenious applications of finding a solution. So we won't tell you upfront what the fee is, but after the fact, we will make sure that it'll hurt your pocketbook. That's an interesting way of approaching those things.
You want to, yeah, Pradeep.
Just one question. It's not clear to me why the fee was imposed only on the derivatives market and not the spot. Is it, was there a rationale for it? I mean, maybe you might want to respond from, so. Because
I mean, I must make a disclosure that, I don't intend to defend the action, but there may be a bias because I was an integral part of the entire decision making. But, just going back to a couple of points, I think the first thing that was important to us was to not disturb market quality. So the plus minus 1% was actually thought to be a very, very sensible, rational way of going about it. So, I would be extremely careful before reducing that plus minus 1% to anything lower, because you really do not want to, disturb market quality. The other point that came out was the average OTR ratio when SEBI took the action in the market was something in the region of 70:1. And the highest OTR that we saw was above 1,000. And when SEBI brought this measure in, I remember very clearly the highest OTR had come down to about 600. So, there are outliers, and I think largely from my understanding, and in fact, the other important point is when NSE brought this move in, it just did it across the board. But I think the SEBI move was very calculated and was targeting only algo trading. And luckily, we have our flags in the market where we can identify what is an algo trade. So we actually did a lot of calculations of, what is OTR on algo trades as compared to OTR across the market. So if, and this is really where I don't intend to defend, but, the fact that SEBI's move was seen as not effective, I would take that really as a positive in a sense that, you brought in a move where you wanted to maybe correct some outliers, but you did not wish to disturb at all the kind of market quality. So, it's a matter of interpreting the results in the way you want to.
Thanks, Raman. Rick?
as a former bureaucrat, I have to commend you that you do an excellent job in being able to give an elaborate explanation without answering the question at all.
They're well trained for that.
You're extremely well trained.
Rick? Yeah.
I had just one small thought. In this sense, the futures and the stock market, the underlying cash are very closely linked. And what you might be able to do is identify an effect much more cleanly in the underlying stock by comparing it to stocks that don't have futures. And at least the identification there could be much stronger, because here you don't have a very good control.
Right. No, I think that's a good point. Yes.
A couple of observations. I was just wondering, in terms of selection, why we were not looking at Nifty futures or Nifty options and the effect of HFT, and rather you went into stocks. Maybe the HFT action is more pronounced there, and one could look at it in that respect, because most of the market action seems to be there. And if HFT is going towards more liquid contracts, maybe that is a better thought
Actually, we do futures. We do Nifty futures.
No, it was only stocks. I mean, or I misunderstood. I thought it was only stocks.
Futures. Okay, I see.
So that is one thought. And then secondly, is algo a good definition, I mean, to pick up, or should I look at co-location and those type of orders, Because algo is a slightly more dispersed term. Yeah. Somewhere where actual HFT is concentrated.
We'd
So
love
you're not,
to have your data on which ones are co-located. No, but I think
I think the co-located flag is much better than algo. Algo is more, it's a little more diffused in my thought.
I think that time is not providing us data, I think.
But I would assume that.
There's no polo flag.
correct.
So wait, but is that the rationale for why cash was never charged in OTR fee? Because the perception or the data shows that OTR is just a lot higher in
No, I'm not aware of those decisions.
That is an intrinsic bias, if I may say, in the regulator's office, that you need to do something to improve participation in the cash markets as against the single stock or the derivative market, because that ratio between the trading ratio between cash and derivatives moved from, I think, parity in 2002 or 3 to 13:1 in favor of derivatives. So there is this concept of trying to do something to make people move more towards cash, which probably has come out in these slide where the price discovery in cash might have just improved because of an OTR on the derivatives.
See, one general question on this band, right, 1% band. Clearly this is not a function of volatility of the stock. It's just a function, like a 1% could be nothing for a very liquid stock, but it could be huge for a small stock, in terms of its bindingness. So I think
Single stock futures are only on 140 scripts.
Right.
So, and these are very liquid scripts. You do not go beyond. In fact, it went to 260 at one point, but it's about 150 right now.
Correct. So, see, the thing about these binding is that, there have been some anecdotal evidence where people can actually cook up orders in order to come within the OTR fee limit. So, because, if you are canceling lot, if I just post orders and trade at the touch on a regular basis, something which will bring my ratio down. Because really, if you think about it, it's like an option, right? So people are willing to push this particular fee if it is binding. In the sense, the cost of the strategy should be, this is the cost of the strategy. If the benefit of the strategy is huge, people would happily pay this fee.
Actually, I should just remind the chairman that this is lunchtime.
Right, yes.
One more small.
Thank you.
Also, I was just worrying when we are saying that we are picking out one and saying that the market quality at different points of time, the market quality could have changed because of many other reasons. Why? Is there any basis of saying that this is because of one specific?
We do
from
the
a
controls,
study?
right? We do.
Yeah, I was just wondering. So those controls,
Right.
whether that really has differentiated, is something which I was.
Just another point, I think Pradeep already mentioned it, but I thought it was a very important point that, between 2009 and 2012, lots more people came into the market looking to doing HFT. So, the fact that the entire market is moving towards HFT somehow needs to be, sort of some regression analysis or something needs to be done to show that, the entire market has moved that way. So the reduction in OTR has to be also looked at when you see the entire market moving up and increasing HFT.
Correct. Thank you guys for all the comments. We'll have lunch now and we'll be back for the next session, which is going to be one. Oh, I'm sorry. Nidhi, want to do a quick response?
I think, thank you so much for your comments, Professor Yadav. I think, most of it, what you said, we will try to incorporate. Regarding your liquidity supply and all, to liquidity supply and arbitrage related transaction costs, those things we are already contemplating. But for the rest, I agree with you completely. We need to figure out how to sell this paper in a larger academic audience. Yeah, that's a tough competition, but we'll work on that. Thank you so much.